Welcome to the Trading Panel, the show where we assemble all different types of traders and we talk about anything trading and the markets. And today, as you can see on the screen, we've got some fantastic guests joining us. But first, welcome, Jason.
Hey, Andrew. Good to see you. Glad you got to get a couple extra hours of sleep, or an hour now. Now with the time change to be an hour, so a little bit more
that's
sleep.
Right.
That's good. Good to see you. And I thought you were gonna say welcome to the Brady Bunch today because it kind of looked like the Brady Bunch thing. But no, I'm excited about this one. You know, Ian's a good buddy of mine. Mish came on. You know, like I'm super excited to have a great conversation. I thought these two would be perfect to have on the panel today, considering these are both very good commodity analysts that we could kind of talk to about trading commodities, futures, you name it. Lots of stories, and this could go many different directions. So we also got Pavel. He has a great fun talking about basically systematic trading and algorithmic trading in the crypto space. So this will be a fun conversation. I'm excited.
Well, I'm excited to be here. Thank you, Jason.
Of course. Thanks for coming on, Mish. Thank you so much.
So where do you want to start, Jason? I think maybe, Mish just dropped off, but Ian's still here.
Yep.
And I haven't met Ian before. I'd love to hear some of Ian's background.
Yeah, Ian, let's hear, what you do at All Star Charts.
So I focus on the fixed income, commodity, and currency markets. So, high level intermarket analysis that feeds into our top down approach and helps our clients guide the equity markets. I get into some of the futures and some of those commodity trades as well. I look at the markets from a technical perspective, study price, went through the CMT program, got my CMT designation recently. So yeah, that's my background. Excuse me. That's how I look at the markets.
Nice. And Mish, for people that don't know, what's your background? How did you get into these crazy markets?
Well, okay. Very briefly, I wound up becoming a member of the commodities exchanges in New York when I was young, and it was an amazing opportunity. It happened, I believe, because of fate. And it was at a time clearly when commodities were going crazy, and also there weren't very many women on the floor. So I kind of got in on this glass ceiling thing, which is interesting. But so I spent 14 years on the floor. So I really learned pretty much everything I'm still doing really has its basis from being a commodities trader on the floor for all those years, because the basic lessons really don't change very much from pure price, momentum, stay out of the dead money, follow the things that have the liquidity, notice there's rotation, understand risk, and also know when something is coming to an end. Make sure you take profits and have stops. And those are the fundamentals that haven't changed at all in terms of trading. But of course, we've all gotten a little bit fancier since then because we all want to sound like we have some kind of leg up on somebody else. But really, that's all it is. That's all it is.
You've got to keep it simple. I mean, really, it's something that you see in markets so much. Some people, I mean, today especially, let's talk about the CPI, and everybody has this idea of it and this idea of it, and the market's going to go up if this happens. The market's going to go down if this happens. Really, you don't have any idea what, the market bottomed on a very terrible CPI print back in October 2022. So why can't the market go up during that? So now you're just going to hear narratives over and over again. It's like, something that you and I have been talking about for a long time is the commodities have already started to move. As the commodities are already starting to move, of course it's going to show up in the CPI report. Like, it's not hard to see.
And what makes this even more nuanced is that it's not, even though I was one of the first ones to show that overlay chart of the 70s to now, and how CPI reached its trough in 77, and then same thing with 2022, and now here we are in 2024, starting to come up several months in a row above 3%. This is hardly the runaway inflation scenario that we had in 1979. So we can't even really compare. We can say different scenarios, but people are so confused and trying to find some kind of a conversation that makes sense when everything has changed. Everything has changed. I mean, gold has been going up not because of inflation, but that doesn't mean it won't start going up if inflation really starts to pick up. But it's not going to pick up based on what we saw in the CPI, because the core goods actually experienced deflation. It was the shelter costs that really went up the most. What's going on here now with gold and silver and possibly miners and copper is really, I think, more based on a chaotic situation that people can't really grasp. The market's up near all-time highs. Even this correction today was basically just testing the bottom of the support of this long channel that we've had for possibly the last couple of months. Essentially what we've got here is fear of war, fear of debt, fear of government spending, fear of, all of this, weather, all of these things escalating to a point where the Fed has to cut regardless of what they say, because the interest payments on the debt are so skyrocketed high that they're going to make a choice. Let inflation go higher, because we don't really believe it's really there. It's more war based, or reduce our interest payments by 33% by lowering just as much as 150 basis points will do that. And that's why this conversation is completely different than 1979. But nonetheless, it is interesting to see the similarities in terms of the CPI.
Yeah, I mean, I think it's interesting, thinking about it in such a historical aspect and seeing where we're going to end up. And not to mention what you just said, the Fed has to cut. I think my favorite writer that I first learned about many years ago, which was Richard Russell. Actually, that's what you and I first started bonding over. And he had that one, what was his phrase? He would always say, inflate or die. The central banks always have a choice. It's inflate or die. And really, it's like,
at that point, T-shirt like that. I'm going to get it.
Yeah, inflate or die. It should really be a T-shirt. But it's the truth. It's their choice right now, what are they going to do if they continue to raise rates with the amount of debt? All of these things are incredibly important here. So I think so many people are thinking, this has to end. The Fed really cares about inflation coming down. It's like, well, they've always inflated. It's just never been to the level that's been this extreme. They've always inflated in a compounding way. Hey, 2% a year, it's safe, it's great. We'll just do that forever till everybody dies, basically. Now it's just, hey, we've just jumped it up to these crazy levels, and I guess we're just going to be here at these levels. I think you and I have talked about it before, too, where I think you mentioned that you thought they might raise that 2% target at some point as well.
Well, they don't seem to be really liking that suggestion at this point, but that doesn't mean that it won't happen. And let's not forget that Powell's term ends at some point. I forget exactly when it ends, but and of course, if there's a Trump presidency, which I don't think there will be, but if there was going to be one, he would get rid of Powell in a second. So that's beside the point. Yeah, I mean, it really is. It's just fascinating to me. This whole thing is so fascinating. I'm finding this to be, and the other difference, by the way, from the late 70s to now is that we have put so much stress on raw materials because of our advanced technology, supercomputers, AI. They use so much electricity. They use water, and electricity comes from raw materials, which is one of the reasons why people are now worried about copper scarcity. So all of this has changed. And so, yeah, I mean, like they say, may you live in interesting times. Also, this is the year of the dragon. And I know, Jason, and this is the last thing I'll say, and then I'd like to hear from the others. The year of the dragon. And the reason why I mention this is because I've been studying Chinese astrology for years. And I study with this guy, Raymond Lowe, who is, he's been all over the media at times because he's probably one of the most world-renowned feng shui astrologists. He studies all this stuff and comes up with all these predictions every year. And he's not always 100%, but he sometimes is very scarily right. And he said, we're still in a year of water domination. And he said, and that really started a few years ago, actually, after 2017. In 2018, we entered water. and we don't come back to fire until the end of 2025. So he's always felt that certain things would happen as a result. But what he did say about the dragon is that it is at the gates of heaven, but also at the gates of hell. And if you think about a dragon, that makes a lot of sense.
I like that stuff is so interesting. It's really fascinating because that stuff is really like when it comes to markets, there's this weird thing, and I think all of our brains kind of hit on certain things. And once again, we're all like looking at the markets, making sure we're making the right decisions based on those. At the same time, it's like you can put together a little bit by looking at that. And also, you're probably getting to the point of China. I think China was also in there too. So it's kind of going to be an interesting year with all the geopolitics that are coming up as well. So, Ian, as well as now we're looking at all this stuff right now. We're looking at the commodity space, which has just been wild. What are you seeing in the commodity space? What are you writing about right now? What's something that's kind of really interesting you lately? Not that everything isn't interesting, but, pick a few things if you can.
A couple, I mean, gold obviously stands out. And I'm not really digging too deep into why gold is breaking out. What's sustaining these new all-time highs. I think it's really interesting to see how it performed today with the strength in the dollar. When I see gold breaking out to new all-time highs, I think back to 2019 when gold completed that 6+ year basing formation, and ended up ripping to its 2020 peak, and that kicked off the commodity bull run that we experienced over the past 3 to 4 years. So witnessing gold do the same thing and silver start to rip too, seeing strength in the precious metal stocks. I think we're kicking off the next leg higher for just commodities in general. Digging a little deeper, maybe cattle are starting to top. Maybe we'll start to see these grains carve out some sort of tradable low. We'll see. But commodities are really exciting right now. Rates continue. The uptrend for interest rates remains higher. That's one thing I've definitely been pointing out for months now, is that until we see some sort of reversal in that secular primary trend, it's hard to latch on or to get behind any kind of falling rate disinflation scenario.
No, I get it. And I think everybody's kind of stuck on this, rates have to come down, immediately scenario, like this is always going to happen. And once again, it's, you got to give you your flowers here. You've been really on that the whole time. The trend has been down. You've been on it the whole time. You've never changed your stance as long as the trend is down. And that's what a good price action trader does, or a good trader in general does. You don't go against the trend. And the trend is obviously bond prices continue lower, yields continue higher, and see where that ends up, because we're not predicting the market. It's nearly impossible to predict where the market's going to be at in a year, but you can take signals, you can put the probabilities on your side. And most of the time, putting the trend on your side raises your probabilities. And like you said, if we go across some of these products like cocoa, just to start off with the craziest one, it's up 173% year to date, which is somebody asked me about that trade the other day, and they were like, man, that's such a cool trade. I'm like, yeah, I don't think I've ever had a trade like that in my life, actually, that's been that high in this short of amount of time. It's very odd to see something move to that degree. Now, once again, it's a thinner market in the commodities market, but seeing that continue to these levels, that's insane. I don't think I've ever seen it before.
And that's going to be great textbook study right there, because the other point I've been trying to write about lately is when these parabolic moves in commodities end, it's not a buy the dip, it's over. You head for the exits and move on. And that will be so classic, and I can't wait for that to happen, because then I think we'll have contextual something to really show from beginning to end a full commodity story. Cocoa. The interesting thing is, when I was down on the floor, my first membership was Coffee, Sugar, Cocoa Exchange. Cocoa was like this teeny little pit with like couple of older guys that would sit in there waiting for an order. It was where you would go if you really basically wanted to take a nap. So to see it now as the premier mover in commodities has been amusing at best.
I mean, I don't think it's ever been that way. Like, I don't think there's ever been a time where cocoa's been the like leader and just continue to move. And like, you're like, oh my gosh, it's the outperformer. Like, I don't think that's happened. Crude is right behind it at 20%. Orange juice is right behind that at 20% year to date. So you're really looking at a lot of these commodities are really starting to take off. Coffee's been very interesting. That's one that's kind of catching up. But really, it's like
keep an eye on uranium too now.
Uranium,
because uranium, of course, is going to relate to if what you saw all over Twitter today turns out to be true, that Iran is going to have a missile strike to Israel. We'll see if that happens. I hope it doesn't, but it's certainly probable.
Yeah.
I just want to say one other thing about prediction, right?
Mm-hmm.
I think it is really hard to predict equities because there's so many factors between changes of CEOs or the board or a bad sales quarter or corporate buybacks or interest rate sensitive or whatever. There's so many variables to really make it difficult to say, oh yeah, I know this is going to be here. Commodities are much easier to predict. They really are. Did you agree, Ian?
I mean, maybe so. And maybe that's why I was always just attracted to commodities. It just made sense to me.
Exactly.
Like companies are just like, what do you do? So maybe maybe that's what it was.
Well, yeah. But think about it. I mean, it was pretty obvious that oil, once it cleared $80 a barrel, I'm looking at West Texas, that was going to be perceived as, obviously Middle East related and supply chain related, which would then get gold going. That was also pretty obvious. In terms of cocoa, once you knew there was drought in West Africa, you knew that was going to be obvious. The same thing that's going on with coffee. I mean, it's like it, and then there's sort of a domino effect with certain commodities impacting other commodities. So you knew eventually silver would have to go up, poor man's gold. The miners, which actually go out and mine for the stuff, if central banks are accumulating so much, makes sense that gold miners will go up. I like that. And I've waited, right. Ian, I've waited 40 years to see this type of action and predictability and fun, to just sit back and basically make money easily in commodities. But as I said before, they'll break your heart one day, and you got to get out and not get attached.
How do you manage a position in cocoa at this point? Because I got buddies that are texting me and they're showing me, these 60-minute charts. I'm like, guys, if you're not already in, like, I don't even know how you would get in at this point.
Okay, so if I were on the floor trading something like that had just gone parabolic, I would certainly not be thinking necessarily that I would be buying the dips. I'd probably at this point thinking that we may be coming to the end of it. I would be looking for decline in volume, decline in open interest, and I would be more scalping it to try to catch some of those swings. Because with so many people in that market and many who don't probably have ever traded a future before in their life, but just joined the party, they're going to be great rallies to sell and great dips to buy. And as soon as the dips get shallower and the rallies and the sell-off from the rallies get heavier, then the move is over. And that's how you have to do. You have to think like a day trader. I would never put anybody in a position at this point in cocoa.
Yeah.
That's what I would tell you, friend, is learn how to be a day trader and almost a scalper and really watch those few things I was talking about. I did point and figure charts. They were awesome.
That's cool.
Yeah.
I'm just running a trailing stop and an exit signal. That's the best I can do. I have no idea at this point. It's one of those things that I've been in a few trades over the years that have actually been like, okay, I'm actually kind of scared. This is one of them. I don't like it. I don't like where I'm at. I don't like the position size. I don't like the volatility of it has gotten insane because I don't vol target my position. So it's kind of ridiculous right now. And I'll be happy when it's over, honestly, because it's running my whole portfolio at the moment.
Oh,
Which has
really?
been cool. Yeah, it's cool at now. Right now, it's moving up, so that's cool. But we all know it's not going to go up forever. So then it's running my portfolio the other way. So my stop has gotten a little bit tighter than it normally would be, which I'm kind of embarrassed to say that because that's not what I really do. But my stop's a little bit tighter. I'm sitting there watching it and kind of going, I'm going to just look at it as least as I possibly can. Have my trailing stop. Keep monitoring my exit signal, and that's all I can do. But like your friend said, like Mish said, I wouldn't touch it right now. I wouldn't add to it. But once again, I could say the same. I could have said the same thing months ago. You know, I wouldn't have bought it here. I wouldn't have bought it there. I mean, that's why I run the systems I do. I don't think I have much of a turning point predictability for myself at all. Mish, on the other hand, has a great. She can do that. Like she said earlier about predictions, like. She can do that more than anybody I've ever met. I cannot do that. So I don't pick turning points.
Just tell your friend to get a graph paper. I wonder if your generation even knows what that is, and do 2 by 2, 2 up, 2 down in terms of bips in cocoa, and start to look at patterns. Even if he never trades it, just to even study short-term patterns in a wild commodity market, because you're not that only happens in commodities.
So short-term patterns on point figure charts.
I love point and figure charts. If I were going to do that sort of thing, that's what I would do. I would go back to the graph paper and watch it, and 2 cents up, 2 cents down, 2 cents up, 2 cents down, X's and O's, until you start to see these patterns. So, guess what I just did before I came on the show, Pavel? I bought Dogecoin.
Yeah, really?
Nice.
I don't have it in the portfolio probably. Let me check it. We have like 25 open positions right now, but Dogecoin is not there. But I just wanted to react a little bit to the question how to trade maybe cocoa in this environment. Statistically said, the best approach is trading short-term breakouts above trending days. So if there is some strong trending day, 1 to 2 days breakout above this high is statistically very, very solid. And on new all-time highs, it is especially strong entry point, statistically said. So these are quite good markets. I like entering in this kind of environment because you can get quite a lot of money from these movements short term. Of course, it is not the best entry for long term to middle term trade, but 1 to 2 days trade, it's just perfect environment. And the more volatile, the better, I would say.
So Pavel, when you're looking at a parabolic move, like you could do that in just about everything. You're talking stocks, crypto,
Yeah,
commodities. That's interesting. Hope somebody goes home and tries to build that model, because I'm definitely going to look at how that works. That's cool. It's a good idea.
Yeah, or
You see the
of
momentum
course
sometimes.
momentum, like short-term momentum trades, or on the other side, short-term mean reversion trades in these corrections. These moves have between 55 to 70% win rate. So this is especially interesting for trading. Again, 1 to 2 days, 1 to 2 days trades. No long-term positioning here.
Nice.
And how do you manage the moves? How do you manage those trades in moves like that, Pavel?
Basically by time stops. So I'm entering with some logic, and I expect to get out in 1 to 2 days or so. These are the type of exits that are the best in terms of profitable to to some drawdown ratio, really, to get in and get out quickly. So this is how I'm thinking about it, and also what statistics is showing long term.
So if you have a time stop, are you just holding it to the close, whether it's 1
Yeah.
or 2 days out? Yeah.
Exactly.
Nice.
It is always the best if you want to be in the market more than 1 day, and in this environment 1 day could be enough, 1 to 2 days. Then I have some safety trailing exit, like if there is really big dip against my position, I'm just getting out of it, or automatically the position is basically switched off.
Nice.
But really, these kind of movements, people are often scared of it, but that's why this is the best, one of the best time to get in, short term, but to get in, because usually these trends, and I love the quote from Larry Williams, that these overextended moves tend to be overextended even more, and statistically it's just true.
I've always loved Larry's work. He just has a real good way of just dissecting the markets. And speaking of another person who has a good way of dissecting the markets, Mish. So I think something that would be fun to chat about, as I was talking the other day, somebody brought up to me something about the reflation trade and saying, it's, you can't say inflation's coming back when financials look this good and so on. So when you're looking at this inflationary type of environment, and you're able to kind of dissect things just as you did earlier. And Ian sees me do that a lot, and I got that from Mish completely. So you're dissecting something where you're going, okay, this is oil. This is what's going to happen with this sector because of this, and so on. So what are you seeing here today? Do you think the market's under enough pressure that inflation's actually putting pressure on the market at this point, where that's why the market might be coming down? Or do you think the market has more room to run? What are you looking at in all the intermarket analysis that you look at?
Well, first of all, just like the commodities markets are nuanced and inflation is nuanced, so are the actual market sectors right now. So semiconductors, even though it's sold off, is still holding up better than most of the other sectors right now, which of course makes sense, because if there's any area that continues to prove itself out, it's the large cap stocks that are related to tech and semiconductors. You look at something like retail, though, my granny retail that I always talk about, that actually collapsed pretty good today and went under its most recent trading range that goes back about 8 weeks, and broke down pretty heavy along with the small caps. So essentially what you really have to say is, what is this telling you? And what it's telling you is that even though the market logically knows higher for longer, to Ian's point, you have to really think about this as, what does that mean for the consumer? It's exhausting. They're exhausted now. And, obviously, even though we saw core goods go down, there's still a lot of things going up, including things that everybody needs, which is auto insurance. I think that rose something like by 23%, which is huge. So, and then now let's look at companies and different sectors. What's going to struggle with higher for longer and slightly inflated costs, not all over the place, but in many places? That's going to be companies that do not have good growth potential, have had terrible balance sheets, have lived off of low interest rates long enough to be able to stay afloat, borrow against their losses and expenses at practically zero for so many years. And so, that's where you start to, almost like the Red Sea, you have to part it and see what's on one side and what's on the other. And this too is going to be challenging for anybody who's invested in this market over the last 10 years, who knows nothing but buy the dip and everything always works out and everything goes up in tandem. That is not true. So I think it does behoove us right now, as people who talk to other people and try to guide them, to really make sure that we ourselves understand the implications, and not necessarily say, oh yes, SPY's going to new highs based on the fact that the Fed's going to cut a couple of more times, or not going to cut a couple of more times, or the stock market's going down to 4,800 because they're not going to cut. I think that is just so oversimplified. and really doesn't explain the dynamics of today's economy, because we spent 40 years in basically ZERP, and that's done. Like Ian said, that's over. That's not, at least not in my lifetime. I don't expect it to come back. You guys are much younger, so you might see it again, but I don't look at it that way. So that's why I start looking at, the rotation. People throw the word around a lot, but they don't really understand what that means. That means real trading decisions. So, we mentioned semiconductors. Right now, obviously, they've come down. If the market was to hold here, probably that would be the sector to go up before anything else. But that doesn't mean that we're going to go make new highs. So what other sectors could be interesting here? That's how I look at it. That's why I've come up with solar energy. Because whether EVs have lost their popularity or not over the last year, you look at a company like Microsoft that is using so much water to power their supercomputers, knowing that they're actually draining resources that are valuable. They're looking at wind and solar energy to be able to provide energy source for them, for that company. Multiply them by every other company. That's huge. So you say, well, solar energy has been so beat up because it just ran out of favor for many reasons, while oil has continued to climb. That to me tells me that keep your eyes on solar energy. First Solar already has been starting to rocket up. And that's kind of like the granddaddy. That's like the NVIDIA of semiconductors for solar energy. But watch TAN, that's the ETF. Watch PBR, I think, is another one that is related. I don't know if it's PRB. Wait, hold on, I'll tell you 1 second. I get my P's confused here. I'll look it up. But there's another ETF that has to do with solar. I forget which one it is now. Something with a P. So that's how I look at it. If you really want to dissect this now, just be a logical human being and realize that interest rates have to have an impact, and things are not the way they were.
No, I like that, because I think it's incredibly important for many reasons. Whether if you're a price action trader, you really have to understand where relative strength is heading to understand where you want to be positioned next. I know you guys have a model and an indicator that you guys built to do that too. So that also helps you to figure out what sector is moving next. Where's money flowing into? Like this month, we've seen it flow heavily into energy. Like energy has been the place to be lately. It's been the place to be for a while now. So now we start to see that start to move, and then we start to see money flowing out of the tech space. And what does that mean? And then the commodities are ticking up. So I love the way, you dissect that, because there's people watching and they can learn how you kind of look at the markets like that. Because to me, that was the first thing I ever noticed about you that was really like, oh, wow, well, that's how I want to look at the markets. I want to be able to put this lens on and basically understand where money could be flowing into. And basically, once you start to be able to do that, you can start to figure out what areas you want to be invested in. And like you said, too, and it's an interesting thing, so many people have learned for so long by the diff has just worked. And it just doesn't work forever. It just never has. However, yeah, sure, you can make a lot of money in it, but as traders, we have to always be positioning for what's best, what's going to be the outperformer. And so I guess the next answer is like you like solar energy, but what else are you liking in the market at the moment?
Well, I'm looking at emerging markets, particularly those that aren't really impacted by inflation. Or won't necessarily suffer if the war gets escalated in the Middle East. And that would really bring us to Asian countries. I was on CNBC Singapore last night, and the gentleman that was on before me was like the guy who runs the banks in Thailand. And it was so interesting because he was talking about the fact that they've had very low inflation. They're talking about cutting interest rates right now because they've been high for a very, very long time. And they feel that they can afford to do that without the risk of getting into rampant inflation. Switzerland just lowered their interest rate recently. So start to look for countries that have had the opposite impact from inflation. They don't necessarily have to suffer from it. And because they have room to actually become a little bit more accommodative in their central banks, they could actually start to outperform. People were rushing into emerging markets last year, and they turned out obviously not to be so happy unless they were like in Mexico. There was a few countries that did very well. But that's the way I'm looking at it. Or if we really think there's going to be stress on our raw materials, what are the countries that produce these raw materials? And those country ETFs could be interesting. Like maybe a Latin America, where people will argue me and say, well, the guy, they're really running those countries terribly there, and you should never get invested. Yeah, but they also have a tremendous amount of raw materials, and who cares about how a government is get led? We can make an argument that people think we have no leadership here, but it hasn't certainly impacted our stock market. So, yeah, that's another area I'm looking at. But right now, I'm just happy being longer in gold, silver, miners. I talked about coffee. I'm looking again at uranium, although that's me and uranium don't always get along very well. And I'm looking at some companies that are in the small to mid caps that have strong earnings growth. We have a model like that, but one is oh goodness gracious, what's the name of this company now? What's the name of that shipping company that we MNN or NMM? Yeah, I'm at the time of the day where my memory for names starts to slip. I think it's MNN. It's Davios.
Yeah.
Oh wow, that just came into my head.
There you go.
Right. Davios, like that stock, if you take a look at the chart, it's just gone straight sideways. Even today, it barely moved. And if there's any supply chain issues, that's a shipping company that's done well. It has great earnings potential, earnings growth. You gotta. This is when people realize that, hey, you know what? Maybe this isn't so easy after all. And I either better learn something or go to cash and come back when things get easier again, or lose all my money and then never come back. That happens too.
So, Ian, you cover the sectors too, right?
I do.
Yeah.
I focus on materials, industrials, energy.
So what sectors are you really looking at now then? What are you looking at any of these commodity sectors as having major outperformance going forward?
I like energy a lot. I like materials, breaking out to new all-time highs. Industrials, have been leading the way. The most, tightly correlated with the broader market. I like just energy, just broadly. Mish, I also like TAN a lot.
Oh, good.
It's actually digging in relative to the S&P 500, right around the 2020 lows. So a logical area to see some
40.
To see some outperformance. So.
Mm-hmm. And by the way, we have an indicator called real motion indicator, which is a momentum indicator, and it's showing a bullish divergence. And that momentum is above the moving averages, even though for TAN is sort of fluctuating around that 50-day moving average and really far from the 200. It's above both the 50 and the 200 in momentum, interestingly enough. Can you excuse me for 1 second?
Yeah, go ahead.
I'll be right back.
Yeah.
Okay.
I did have a question for Pavel, because we're looking at the market right now and looking at the crypto markets and seeing all these underlying small crypto names, and some of them are moving, some of them aren't moving. I know you are trading a lot of these. How small can you get in your models and still trade something? Like what's the smallest coin you trade?
It's a good question, but it really depends. If you are just a retail trader that is trading their
I'm
own
talking about
solution.
you personally for your fund.
Well, we in our company, because we are covering institutional clients and retail clients, we are trading like top first 40 to 60 most liquid coins on crypto futures universe. If I would be individual trader only, I would go a little bit farther. But on the other side, if you make some tests or many tests, you can find out that these really small coins tend to not trend for a long time. They really suffer from these pumps and dump schemes pretty heavily. So you have to change your models accordingly. So you can really see some differences between those very really small coins and those bigger ones like Bitcoin, Ethereum, these like top 10 by liquidity, you can already see some kind of long-term trendiness. But in most crypto coins, in crypto in general, yeah, they tend to really move, like I would say, commodities on steroids, like on short-term cycles, very volatile ones, much more short-term compared to commodities, but they don't have these long-term trends like stocks usually based on the data.
Yeah, no, it's interesting because I've been looking more into possibly adding some more. I only use the futures market at the moment, so I'm only using Ethereum, Bitcoin. I'm kind of dabbling with that idea a little bit. So thanks for that answer. I'm kind of thinking about it a lot more.
Yeah, well, you definitely should, because especially for trend followers,
Mhm.
I could show you dozens of models, and
Well, you're the only
think
reason why I'm thinking about it, because I have seen your work, and
Yeah.
I've always been like, you know what, I'm just gonna stick to the biggest ones, and that's it. And so
Yeah.
that's how I'll make my money, and it's been great. However, adding more markets, it could be even better. So we'll see where that ends up. But thanks for the
Yeah, of course,
motivation.
because I like opening these eyes, because it's about immature versus mature market. Bitcoin is still very volatile compared to traditional markets, but compared to coins on for 30 40s position based on liquidity, it is much more mature, and you can see it on day-to-day volatility of Bitcoin is 4 to 5%, lower coins easily 9 to 10% daily. So this is what it is about. And these trend following models are like, make your tests on commodities and make it times 5 to 10, and you can see the potential of crypto right now. So this is also the reason why we are running our company basically on crypto, because we can make the most money there. It is not that I'm in love with crypto, not at all, but it is the most volatile, most trending asset. So that's why I want to be here, and I want to take the advantage, because I can also see, if you go to 2008 9 oh sorry 18 19 compared to 22 23, you can see that even this asset is starting getting a little bit more mature compared to 4 or 5 years ago. So I expect for sure that the volatility and trendiness, and we were discussing it with Mish too, that it will be evolving, and it will be similar to, I don't know, the trend in commodities and stocks in tech bubbles and so on. So it will be more standardized over the long term, but right now is just the place to be, in my opinion, for traders, not for investors. I don't think it is an asset for long-term investment, except of maybe Bitcoin, maybe Ethereum or so. Depends on what you believe in. But for traders, it's heaven.
Amen.
Mish,
Andrew, you want to go through? Oh, go ahead, Andrew. Go
I was
ahead.
just going to ask a question for Pavel, because Mish was talking earlier about, I guess, intermarket analysis and understanding the interactions between different markets. Do you see that same kind of concept in crypto with some of the, I guess, the larger coins, or maybe they're built on some specific technology or have a story? Do you see that working in crypto as well?
Yeah, well, I'm not doing this intra-market analysis in crypto, because I just don't have enough data. Like 5 6 years of it's nothing, to make some baseline for real trading. But you can, of course, you can see that Bitcoin is usually starting the strongest trends. So if Bitcoin is trending, you can expect that few days later there will be the smaller coins trending, and this is one of them. I was also studying some types of correlations to traditional markets, to Nasdaq 100, for example. So you can see there, but it's not statistically strong enough to use it in your trading models. What's interesting, maybe what is interesting are statistical arbitrages, because I used to be trading then in stocks. 6-7 years ago, and then it was only the game of time. Later on, or these days, it's not for retail traders, and it is definitely a way how more skilled retail traders could be making money in crypto right now, because there are really, these inefficiencies are much bigger than anywhere else.
But I imagine to be able to leverage that, there's technology factors, right? And being able
Yeah.
to even test that kind of is a bit more complicated, I guess, than
Yeah, well,
traditional testing strategies.
there is no tool for testing crypto, for example, portfolio crypto trading. There is no tool for making your survivorship bias test, and so on and so you have to basically build everything. So this is for skilled programmers for sure. We have built it for 1.5 years in three people, and one more team of another 3 people. So yeah, it takes some time, but it's worth it.
Yeah.
So Andrew, do you want to hit some of the questions in the chat?
Yeah, I was saving this one for when Mish got back, because I think this one popped up when Mish was talking about the Intermarket, or the relative strength. So I'm just trying to find it in the chat. Here we go, from Sambo. What does the panel think about RRGs, which I think are relative rotation graphs? I'm looking at a weekly RRG of the 11 S&P 500 sectors, with energy firmly in the improving quadrant and pointing towards the leading quadrant. What do you think about RRGs?
Well, I immediately think of Julius de Campinar, which I would imagine this person might be a student of, who has a whole system using RRG. In fact, I think it's called RRG or something like that. Yeah. And I love Julius, by the way. We have been together several times. Okay, there you go. We've been together several times through stock charts, and he's working with stock charts now, and he does great work. And here's a great example of, you find a system, you stick to that system, you become a specialist in that system, and with that level of consistency, obviously all systems go through cycles, and at some point what worked great may not work great another time, but for now, and for a while now, that RRG system has worked well. Why? Because it's on the basis of following the momentum. The leaders that tend to lead will continue to lead. That is an adage that has been around for many years, but I think even more so in the last year and a half, we've really seen that to be the case. So if he's telling you that we're going to go into this final quadrant with energy based on all the parameters that you and I are looking at, maybe more informally, I'd say he's probably right.
Yeah, I mean, I love the RRG charts as well. Those relative rotation graphs, when those tangents start to move into that final leading quadrant, I mean, that's just strong outperformance. And we've seen energy outperform. And I think if you dig a little deeper into the energy sector itself, I mean, oil refiners have just been by far just outperforming the rest of the space. I think in the coming 3-6 months, we start to see a rotation out of those refiners and down into maybe some E&P names, into the services names, and they take over the leadership roles. Something to look at.
Yeah, I love RRG. That's something. Well, it's funny because when I first started, there was a guy who built something kind of similar on a spreadsheet, and I stole it. And I tried to make it a little bit better, and then I was on stockcharts.com, and I was like, oh, there's this guy who has it completely figured out. So no, I'm a big fan of it as well. If you, Sambo, I think you and I have talked before. If you've seen my page or my work, you see those charts all the time. Energy, it's funny because the way you talked about it, energy, literally, if you look at one of those charts, it looks like a rocket ship right now, like coming from the laggards all the way to the leaders. It's just a rocketing straight up. And it looks really good. I think that's the thing. The energy sector, it's gave us a lot of signals pretty early this year, and they've just continued. So it's like, I think you kind of have to be very open to this energy trade, especially as it's breaking to all-time highs. Not all-time highs, but 52-week highs, and it's continuing higher and higher. It's and also just looking at those charts, you can also see what regime we're in. I think that's really important too. So being able to see, okay, like what is starting to lead the way? Where are we seeing relative strength? Well, we're seeing it in energy. We're seeing it in financials. That's telling me we're in a kind of a reflationary style environment. Doesn't mean I make all my trading decisions based on it, but it can help me to figure out where I want to be positioned, what I want to be taking signals in, and how to manage those. So I really do like those charts as well.
If I can just quick mention, I don't know RRGs to tell you through, but to me it seems similar to basically rotational momentum strategies that are built on relative strength, and those are, I would say, one of the most robust statistical models that one can trade. So, and there are also many papers. So if someone likes statistics, like me, for example, you can just Google papers on rotational strategies, and there are many, and really they are going far to the past, and you can see that they have really strong fundamental basis.
Yeah, I think the first person, I think, and all of us, most of us on this panel, the first person I saw doing some work on that that was interesting was probably Meb Faber. Meb Faber did a lot of interesting work on that stuff. And the white papers are still out there. They're still really good to go through. Yes, they're pretty dated by this point, but you can build your models kind of based on what he puts out there. So if anybody is looking at this and listening to this and trying to build their own strategies to figure out which sector is having outperformance or not, that's cool. I mean, even though there's a very simple strategy of just kind of taking the top 4 sectors at any point, as long as the S&P 500 is over the 10-month moving average. And this outperforms the market drastically with a lot smoother drawdowns and so on. So I think it's super interesting. I love that you're looking at that. I think Samo and I talked once before, and he's actually a younger guy. So, he'll talk to us in a few years. He'll probably be the richest one out of all of us. I'm always excited because he's always on here, and he's very knowledgeable, and he knows so much. And I'm excited to see you on here, Sambo, and hopefully we'll talk again soon.
Right, so I think we've got a hard stop at the top of the hour, don't we, Jason? So,
yes.
Were there any other comments or questions in the chat that kind of got your attention before we start wrapping this up?
I just like the other thing that was said was, if you can see where the money is going before it does, you win, by TWISI. That's honestly the name of the game and what we're talking about when it comes to momentum. And honestly, like, that's what he said that when you were talking, Mish. So I'm pretty sure that's part of your game as well.
Yeah. And you want to get in there before everybody else does. I mean, I've said this before, but now I have the classic example with gold, because for 2 years I've been telling, short of sounding like Peter Schiff, I didn't want to go that insane, but no offense to Peter. I mean, he's actually turning out to be pretty smart about the gold, and he's been very convicted, but so was I. And I've been buying gold since $1,200. $1,200 added to $1,500, kept add in and out, then over $2,100 because I knew that was the major breakout, and then when everybody else starts talking about gold, or we used to say on the floor, when you get in a taxi and the taxi driver tells you, I think you should buy gold, it's usually getting near the top. I mean, that's the herd mentality, that when it gets too crowded, it means they're too late. And you're like, thank you very much.
Yes, a good point. Well, Andrew, you want to end it there?
Yeah, that sounds like a good way to end it. So, who wants to start with Jason, how about you? How do people get in touch with you? learn more from you?
Well, you guys can find me on just about everything at AAO Research. That's for Against All
Just look for
Odds.
the pink day glow.
Yeah. It's just for well, actually, what's funny, somebody made a joke about it the other day. They were like, "Why? This guy has LEDs up there," and it's actually a sign. I can't really show you right now, but it's a sign that says "Better late than ugly" on my wall that my fiance bought. So it gives us this nice glow. So, but yeah, so it's AAO Research, just about on everything. My Substack's Against All Odds Research, AAO Research as well. And so you guys can follow me on there, see what I'm up to.
Excellent. How about Mish? You're next.
Well, at Market Minute is my Twitter handle. I'm very active there. I also am on media a lot, so I not always will put what media I'm going to be on Twitter, or excuse me, X. But I do a daily market. It's called Mish's Market Minute, and that you can find at marketgauge.com, which is our website. And there I list what appearances are coming up. I put the clips of what has happened, plus my thoughts on the market. And I do that almost every single day. So essentially, you can, like Jason, you could pretty much find me anywhere. I'm kind of hard to miss these days.
Yeah, excellent. And Ian, it's great having you on the show today.
Thank you
Where
so
can
much for
people
having
find
me.
you?
Yeah, you can find me at Ian Culley on Twitter and allstarcharts.com. And I jump in and hang out with the guys on Stock Market Media .com's the YouTube, Stock Market Media YouTube channel. But yeah, I'm just kicking around Twitter. I write four columns at All Star Charts. One gold related on Mondays, the gold rush, and then I cover currencies, fixed income, and then commodities every week.
I am now following you, Ian.
Oh, yep. As you can see, I'm already following you, Mish.
I did see that, but that did not sway my decision, I swear.
Is Market Minute a new app? Is that a new application? There was a new app. StockPick.
StockPick.app. I'm doing stuff for them. Yeah.
I saw you. Yeah, so it was like last week. I picked that app up and I saw.
We could talk about that more. I'd love to talk to you some more, actually.
Same. I would.
Okay. And of course, thank you, Pavel and Andrew. And I know we haven't had the chance to talk. And Jason, of course, you know how much I love you.
Pavel, where can people find you?
Yeah, just follow me on Twitter, or if you want to know more about what we are doing for our institutional clients and retail ones, just check robuxio.com/explainer, and you can learn a little bit more.
Excellent. Thank you. And then, of course, bettersystemtrader.com and Twitter, YouTube, everywhere. So thanks, everyone, for joining us today. We've got a couple of nice comments in the chat here. This one from Sambo I like. Let's end on this one. Thank you for the feedback, everyone. Incredibly helpful. So it was great to have everyone's opinions today. And catch us next week, Wednesday, 4 p.m. Eastern.
Yep.
4 p.m. Eastern. Yeah, we've changed the time. So catch you then.
All right.
Have a great rest of the week.
Bye, Mitch. Love you. See you later.
Bye, everybody.
See ya.